While the retail public is hyperventilating about artificial intelligence stocks and chasing the next chip manufacturer, a silent massacre is taking place in the back of the market. Nearly $1 trillion has been wiped from software stocks globally in just the last few weeks. This is not a correction. This is a bloodbath. The iShares software ETF is down 22%. Salesforce is down 27% year to date. Intuit is down 34%. Workday is down 30%. These are not speculative penny stocks. These are the blue chip backbones of the American economy. And they are being slaughtered. Why? Because of a specific phrase that UBS just used in a note to their wealthiest clients. They called this situation an unresolvable existential threat. When a major Swiss bank uses the word existential, they are not talking about a bad quarter. They are talking about extinction. Most investors are sitting on these stocks in their 401ks right now, oblivious to the danger, thinking they own safe tech. But what they actually hold is a ticking time bomb. The market has fundamentally shifted, and the reason isn't interest rates or inflation. It is something much more specific, and it started on a specific day. The trigger was February 3rd. On that day, a company called Anthropic dropped a bomb on the industry. If you don't know Anthropic, they are the quiet rival to OpenAI, backed by Amazon and Google. They released a new version of their model, Claude, specifically designed for legal work and contract review. Overnight, the value proposition of the entire legal software industry evaporated. Thomson Reuters, which owns Westlaw, dropped 19% in a single session. LegalZoom crashed 18%. Why? Because these companies charge thousands of dollars a year for software that helps lawyers review contracts. Claude now does it for free, and often it does it better. This was the wake-up call. Wall Street suddenly realized that if an artificial intelligence agent can replace a lawyer's software, it can replace any software. The panic spread instantly. First, it was LegalTech, then it was private credit firms, then insurance brokers, then real estate services. It is like watching a horror movie where the monster keeps finding new victims in every room of the house. But here's where it gets interesting. While the market is panic selling everything that looks like software, the institutional desks at Goldman Sachs are quietly doing the opposite. They aren't buying everything, of course. They're not stupid. They have identified a specific kill list of 41 stocks that they believe are going to zero because of this shift. But more importantly, they have released a secret buy list to their private clients. This is a list of 26 companies that look like software stocks, but actually possess a secret immunity, a specific set of traits that makes them not just safe from artificial intelligence, but the primary beneficiaries of it. If you hold the companies on the kill list, you are likely going to lose a significant portion of your wealth in the next 2 years. But if you swap them for the companies on the buy list, you are positioning yourself in front of a 192% profit wave. So how do you tell the difference? How do you know if the stock in your portfolio is a future bankrupt dinosaur or a future monopoly? It turns out you've been looking at the wrong numbers. Revenue growth doesn't matter anymore. Gross margins don't matter anymore. In this new world, there's only one metric that matters: the seat compression ratio. And once you understand why the per-seat business model is mathematically doomed, you will never look at a software stock the same way again. To understand why this massacre is happening, we have to look at the fundamental economics of the software industry. For the last 20 years, these companies have operated on a specific model, the per-seat business model. If you run a business, you know this pain. Whether it is Salesforce, HubSpot, or Workday, they charge you a subscription fee for every single human employee who logs into their system. If you have 100 employees, you buy 100 licenses. If you grow to 1,000 employees, you buy 1,000 licenses. But think about the perverse incentive structure here. These software companies only grow if you become less efficient. They need you to hire more middle managers, more data entry clerks, and more administrators so they can sell you more seats. Their revenue growth is directly tied to your corporate bloat. Now, enter the artificial intelligence agent. This is not just a chatbot, this is an autonomous worker. One single artificial intelligence agent can now do the work of 10 junior employees. It doesn't sleep, it doesn't complain, and it doesn't need health insurance. So what happens to the company that adopts this technology? They don't just stop hiring, they start firing. They fire 90% of the staff. And when those 90 people leave the building, what is the very first thing the IT department does? They cancel 90 software licenses. This is called seat compression. And it is the mathematical death of the traditional software industry. Revenue doesn't just go down, it collapses. Because the customer isn't leaving the software, the customer is leaving the human workforce. Look at Salesforce. They are currently hyping a new product called Agent Force. It sounds cool, right? It is a digital worker that replaces human customer service representatives. But pause for a second and think about the suicide pact they just signed. Their entire business model, billions and billions of dollars in revenue depends on charging for human seats. Now they are selling the very tool that eliminates the humans. It is like a pharmaceutical company inventing a pill that permanently cures the disease they sell chronic treatment for. It is great for the world, but it is catastrophic for the stock price. This is the efficiency paradox. For 20 years, software revenue grew because companies got bloated. Now, companies are getting lean, and lean companies don't buy enterprise software licenses. Goldman calls this the deflation of the seat. It is not just Salesforce. It is every company that acts as a middleware layer for human workers. If the human is gone, the middleware is worthless. So the market is panicking, and the market is right to panic. But amidst the wreckage, there are survivors. Goldman Sachs argues that in this new reality, the old metrics like user growth and retention are now useless. You can't value a company on headcount growth when headcount is going to zero. Instead, they have identified 3 specific moats that an artificial intelligence simply cannot cross. These are the only safe harbors left. If a company doesn't have at least one of these 3 traits, it is kill on sight for the institutional algorithms. Most investors are still looking at gross margins and PE ratios. They are looking at the past. Goldman is looking at physicality, entrenchment, and integration. And if your portfolio doesn't have these 3 specific traits, you are holding a bag of zeros. What is the one thing artificial intelligence cannot do? It cannot exist in the physical world. It cannot pick up a screwdriver. It cannot weld a pipe. It cannot lay a fiber optic cable across the Atlantic Ocean. This brings us to Goldman's first survival trait, physical execution. The vast majority of software companies live entirely on a screen. They are just code. Code is cheap. Code is replicable. Code can be written by an agent in seconds. But companies that bridge the gap between digital intelligence and physical reality possess a moat that no algorithm can cross. Think about cloud infrastructure. An artificial intelligence model lives in a data center. It needs electricity, cooling, and massive server racks. It cannot build its own house. Therefore, the companies that own the land, the power, and the metal are immune to digital disruption. In fact, the smarter the AI gets, the more physical infrastructure it demands. If your software company owns physical assets, it survives. If it is just pixels on a screen, it dies. Trait number 2 is even more powerful, but much less sexy. It is called regulatory entrenchment. Why won't the Pentagon switch to ChatGPT? Why won't your bank switch its core ledger to an open source model? Because of the regulators. In industries like healthcare, finance, and defense, the cost of failure is not a bug report. It is a lawsuit, a fine, or a prison sentence. These industries are terrified of hallucinations, when an AI confidently makes up a lie. Therefore, companies that have spent decades getting certified, audited, and approved by government bodies have a regulatory moat. It doesn't matter if a startup builds a better tool for half the price. If the FDA or the SEC hasn't blessed it, it doesn't exist. The incumbent software stays not because it is better, but because it is compliant. And finally, trait number 3, deep integration. This is the spaghetti code defense. Imagine a piece of software that has been running a company's supply chain for 20 years. It connects to the warehouse, the accounting system, the shipping logistics, and the payroll. It is a messy, tangled web of dependencies. An artificial intelligence agent can write code, sure, but can it safely untangle 20 years of corporate mess without crashing the entire business? No CEO is going to take that risk. Goldman argues that if a software is deeply integrated into the operating system of the business, the switching cost is effectively infinite. It is too painful to leave. But if the software is just a surface layer tool, like a calendar app or a document signer, it is easy to rip out. So we have the framework. To survive, a company needs physicality, regulation, or deep integration. If it lacks all 3, it is walking dead. Who is on the kill list? Let's start with the most obvious victim, DocuSign. During the pandemic, this company was the darling of Wall Street. But let's be brutally honest about what it actually is. It is a feature, not a company. It allows you to digitally sign a piece of paper. That is it. Artificial intelligence can now generate, review, and sign a document in milliseconds. Why would anyone pay billions of dollars for a company that does something a free plugin can do? This is what Goldman calls commoditized logic. If your software just moves a document from point A to point B, you're dead. The same goes for Monday.com and Asana. These are project management tools. But what is project management? It is organizing tasks and nagging people to do them. Artificial intelligence is the ultimate project manager. It doesn't need a colorful dashboard to know who is late on a deadline. It just does the work. Next on the chopping block are the middle management killers, Workday and HubSpot. Workday makes billions managing human resources. HubSpot makes billions managing marketing emails. But ask yourself, who uses these tools? Human beings in the HR department and human beings in the marketing department. As artificial intelligence replaces the mid-level marketing manager who writes email copy and replaces the HR administrator who processes benefits, the user base for these tools shrinks. You don't need a massive enterprise license for Workday if you have 90% fewer employees to manage. You don't need 500 seats on HubSpot if one artificial intelligence agent is running your entire email campaign. These companies are priced for endless growth in human headcount, but we are entering an era of human headcount contraction. And when the humans leave, the software revenue leaves with them. And then, the most controversial name on the list, Intuit, the owner of TurboTax and QuickBooks. This company has built a fortress on one thing: complexity. The American tax code is a nightmare, and Intuit sells you the solution. But here's the problem. Artificial intelligence loves complexity. An artificial intelligence agent can read 70,000 pages of tax code in a second. It can categorize every single transaction in your bank account instantly. It doesn't make mistakes, it doesn't get tired, and it doesn't charge you $100 to file a simple return. Goldman argues that Intuit's entire moat is artificial difficulty. They rely on things being hard so they can sell you the easy button. But when artificial intelligence makes everything easy for free, the easy button is worthless. The barrier to entry for accounting software has dropped to zero. Before we reveal that secret industrial winner, we have to look at the 26 crown jewels that Goldman says will rule the new digital order. These are the companies that capture all the value lost by the losers we just discussed. The first group is the infrastructure monopolies, specifically Microsoft, Google, and, surprisingly, Oracle. Why do these three win? Because they own the picks and shovels. While everyone else is trying to find gold, these three are selling the excavators. They own the physical data centers, they own the cloud compute, they own the proprietary models. Microsoft and Google are obvious. But Oracle is the shocker here. Goldman calls them a buy, because they have effectively become the plumbing for the artificial intelligence economy. They have a $500 billion revenue backlog. Why? Because they signed massive infrastructure deals with NVIDIA and OpenAI. They aren't trying to build the smartest chatbot. They are renting out the digital land that the chatbots live on. The second group of winners are the AI bodyguards, specifically CrowdStrike and Palo Alto networks. Here is the thesis. The more artificial intelligence code there is in the world, the more vulnerabilities there are. Artificial intelligence can write code faster than humans, which means it can write bugs faster than humans. It can also write malware, deepfakes, and phishing scripts. This creates a massive, non-negotiable demand for cybersecurity. Goldman views these companies as a tax on the entire artificial intelligence economy. You cannot deploy an autonomous agent without a shield. Therefore, CrowdStrike doesn't get disrupted by AI. It gets supercharged by it. The more dangerous the digital world becomes, the more valuable the bodyguard becomes. And then we have the government spook, the ultimate regulatory moat, Palantir. While other software companies are fighting over small business contracts, Palantir is running war zones. They manage data for the Pentagon. They handle intelligence for the Western world. This is the definition of deep integration. Do you think that United States military is going to switch to a cheaper open source alternative next week? Absolutely not. The switching cost is effectively infinite. Palantir is the only software company that acts like a defense contractor. They have the regulatory entrenchment we talked about earlier. They are safe because they are certified to handle secrets that would send a normal CEO to prison. So, you have the infrastructure, the bodyguards, and the spooks. These are the tech winners, but if you only buy tech stocks, you are missing the single biggest percentage gainer in Goldman's entire report. You see, the problem with tech stocks is that everyone knows about them. They are expensive. But there is one sector, a boring, gritty, old-school industry, that Goldman predicts will see profit growth of 192% this year. It isn't chips. It isn't software. It involves 18 wheels, diesel engines, and a massive inefficiency that artificial intelligence is about to fix overnight. And unlike the tech stocks trading at 50 times earnings, this sector is trading at dirt cheap valuations. The sector is transportation and logistics. We're talking about trucking companies, shipping fleets, and freight management. This is the ultimate physical execution play. You cannot digitally transport a pallet of bricks. You need a truck. But right now, logistics is one of the most inefficient industries on Earth. Empty trucks drive millions of miles every day. Routes are poorly planned. Fuel is wasted. This is where artificial intelligence changes everything. It optimizes the physical world. It ensures the truck is never empty. It calculates the perfect route to save 20% on fuel. Goldman predicts that while software companies lose revenue to AI, transportation companies will simply lower their costs and increase their margins. A trucking company that uses artificial intelligence doesn't get disrupted. It gets 192% more profitable. The valuation gap here is insane. Software stocks, even after the crash, are trading at 27 times earnings. Transportation stocks are trading at single digits. This is the valuation reset. The smart money is moving from the overvalued virtual world to the undervalued physical world. So here's the conclusion. The era of blindly buying tech is over. We are entering the era of the split. The winners will own the infrastructure, the regulatory licenses, and the physical assets. The losers will be the ones selling commoditized logic and middle management tools. Don't be a victim of seat compression. Audit your portfolio today. Look for the 3 traits: physicality, entrenchment, and integration. If your stocks don't have them, get out. The great software massacre has only just begun, and the transfer of wealth from the seat sellers to the real-world owners is going to be ruthless. Download the full list, do your own research, and remember, if Wall Street is selling, you should probably stop buying.